So, welcome to monetary policy and something called the monetary policy transmission mechanism. In other words, how a change in the bank rate affects the real economy. So it occurs through this mechanism, okay, and is really quite straightforward. Okay, so the bank rate is the rate at which the Bank of England lends to ordinary high street banks when they need to borrow more in order to maintain their liquid assets ratio. In other words, the amount of cash, basically the amount of cash that they have. And so by changing that rate, then it will affect all the other market rates in the UK economy. In the UK economy, there are many market rates, and of course the rate of interest depends upon how long the loan is for and also how risky it is. The longer the loan and the more risky, the higher the interest rate tends to be on any particular loan. Why? Because really, if you lend money to people, you haven't got it to spend now. So the compensation for that opportunity cost is the interest rate, in other words, the price of money. Those market rates will vary from bank to bank, and of course banks are in fairly competitive situations. Okay, changes in the bank rate will also affect asset prices, because if the bank rate were to fall, then it tends to increase confidence in the economy, and especially people expect the bank rate to be maintained at a low rate. Then house prices, we're talking mainly assets in terms of property, house prices will tend to increase, and so will share prices. Okay. A third factor, of course, in general is consumer confidence and business confidence. If interest rates are lower, then there will be a feel-good factor. Consumer confidence will tend to increase, and also business confidence will increase, which will affect the real economy. And lastly, the exchange rate is determined by a number of factors. Well, perhaps the most important factor is often the prevailing interest rate. If interest rates fall, it tends to lead to a depreciation of the exchange rate. So how does this affect the real economy? A quick drink of tea. Very nice. So, if the bank rate falls, then market interest rates will tend to come down. Then it'll lead to greater consumption investment. Why will it lead to greater consumption? Well, first of all, savings levels will tend to fall. The savings ratio will reduce, and the marginal propensity to consume will tend to increase, because it's less worthwhile to save if interest rates are lower, because the gains from saving are less. So consumption will tend to increase. Secondly, people have mortgages. If you've got a variable mortgage or a tracker mortgage, this changes as the interest rate changes, and if the mortgage payments are lower, your monthly interest payments on your mortgage, MIPs, fall, then you have more effective disposable income to go and consume, and to buy a beautiful dress or a nice shirt or a new car or whatever you want. Also, if interest rates are lower, then individuals will borrow more from banks in terms of loans, take out larger overdrafts, and also on the credit card. Do we have one here? Yes, good old credit card. People will borrow more on their credit cards if the interest rate is lower, again because the opportunity cost of borrowing falls. Maybe loan sharks, who knows, their rates might fall, not a good rate to borrow. Okay. Nor payday loans, perhaps. Anyhow, the other issue is what will happen to the level of investment. And firms have a number of potential investments they might be able to make in fixed capital. If interest rates fall, then less profitable investments might be worthwhile, and they also might bring forward investments that were going to take place in the future. So the level of investment will increase. And also, what happens to the price of exports? Okay, well, exports become cheaper. If the demand increases for exports as a result, then there'll be an increase in net external demand. Imports, of course, will become more expensive. So this is assuming the fall in the bank rate is a fall in interest rates, the exchange rate depreciates, therefore. Exports become cheaper, therefore more of them. Imports become more expensive, therefore there are fewer imports and more domestically produced goods as substitutes. This feeds through, therefore, to an increase in consumption, investment, and X minus M, which increases aggregate demand in the UK economy. Okay, this should then feed through to higher rate of inflation. Now you may think, well, the Bank of England wants to keep inflation down. Well, of course, it wants to hit its symmetrical target symmetrically in the middle at 2%. It doesn't want inflation to be at 1% or 0.5%. I mean, there may be a danger of deflation if inflation gets too low. So it wants to hit the target symmetrically, so inflation would increase. And of course, other things being equal, unemployment would fall and economic growth would increase. Now, import prices. If import prices increase, that will of course feed through to high inflation as measured by the CPI or the RPI. Now, how long does this take? Well, when you set the bank rate, you're acting preemptively in order to determine an inflation rate. Once you've gone through this long process, in 2 years' time, it takes really 2 years for changing the bank rate to fully work its way through to a change in inflation rate. So controlling the economy using monetary policy does involve significant time lags, and it's a bit like steering an oil tanker. I don't know if many of you have done that, but can you imagine a very heavy big oil tanker? If you put the brakes on, it takes miles to stop, and vice versa if you speed it up. Now, it's a similar analogy to changing the interest rate. Now, if we evaluate interest rates, what would we say when rather evaluate monetary policy? What we would say is, first of all, there are significant time lags. So monetary policy, before it has its full effect, takes up to 2 years. Secondly, there's a problem of the liquidity trap. Once interest rates reach a very low level, so the bank rate in 2009 was reduced to 0.5%. Well, at that level, if you reduce it, say, to 0.25%, it's really not going to have much impact on the real economy. And Keynes had this beautiful description. He said it's like pushing on a piece of string, has no impact. So this is a problem. Monetary policy stops working effectively once interest rates reach a very low level. Thirdly, it's obviously not an exact science, because setting the right rate depends on predicting what's going to happen over the next 2 years. Tricky, okay? Fourthly, what about fiscal policy? If the government changes fiscal policy by reflating and deflating the economy through fiscal policy, this is obviously going to have an effect on aggregate demand that might counter the change in monetary policy. Doesn't need to be coordination there, now that the Chancellor sets fiscal policy and the Governor of the Bank of England, the MPC, set monetary policy. And the last point really is distributive effects. If interest rates fall, and there have been at rock bottom since 2009 for several years, savers get a very poor return on saving. Remember to look at the real interest rate. The real interest rate is the nominal rate minus the rate of inflation. So if you're getting an interest rate, say, of 2% on your lovely savings, well, really, if the inflation rate is 3%, you're actually getting minus 1%. Not too good. People don't always realise this, of course, which is called money illusion. So it affects savers, particularly those who are retired, depending on their savings, their lifetime savings. It'll affect households with big mortgages. If you're a first-time homeowner and you have a huge mortgage, then a small increase in the interest rate could really reduce your effective disposable income. So they're affected disproportionately. Third, some firms, particularly a manufacturing firm, and you're a small firm, you might have to borrow from the bank. And therefore you might be particularly sensitive, your balance sheet might be particularly sensitive to changing the interest rate. Okay? So these are some of the sectors that are disproportionately affected by changes in monetary policy. And of course firms are also going to be affected by the change in the exchange rate. So say we tighten monetary policy, which occurred in 1979-1980, what happens is firms have to pay more on what what they borrowed to buy equipment, to buy fixed capital, and secondly they'll suffer from the higher exchange rate. So monetary policy, there are quite a few key points to evaluate. Hope that was fun. Thank you.